welcome back to the deep dive. This is where we really try to untangle some complex global systems, make them make sense. And today we're tackling something, well, it's invisible, mostly silent, but you could argue it's maybe the most powerful force shaping our world, the US dollar. It's not just currency, it feels more like the operating system for global finance, doesn't it?
Right.
Our mission then is to figure out how this one nation's green paper ended up, becoming the financial bloodstream for basically everyone else. Why does almost every big decision, buying oil, trading goods, getting a major loan, why does it always seem to loop back to Washington, D.C.? Okay, let's try and unpack this. It's a lot.
It really is. And what's truly fascinating, I think, is how it blends the mechanics, the actual plumbing of finance, with psychology, pure belief. It's created this kind of financial supremacy that, frankly, military power often struggles to match. So yeah, we're going beyond just the economics today. We need to dig into the foundations, what holds it up, and maybe what could possibly shake it.
Right. So first, we just have to get our heads around the sheer scale. How dominant is it really? Our sources call it the bloodstream, right? Fueling everything from...
Tokyo to Buenos Aires, London to Lagos.
Yeah.
That language isn't really hyperbole. And the numbers, well, the numbers back it up pretty starkly. They're the clearest way to see the footprint. When you look at global trade, the figure that keeps coming up is around 88%.
88% of all global trade.
Denominated in U.S. dollars.
Yeah, think about that. So wait, if I'm, say, a company in Germany buying something from Japan, neither of us is American. We still use dollars. Why?
Well, that gets to the core of it. Liquidity, trust, deep habits. We'll definitely get into that. But the immediate effect of that 88%, it means pretty much every country, every big corporation has to constantly find ways to get and hold dollars.
Just to function.
Just to play the game. If nearly 9 out of 10 international deals need dollars, you need dollars on hand. Simple as that. It forces this constant demand.
Okay, so that's trade. What about, like, savings? Where does the world park its money?
Right, that's the stability angle. The numbers suggest roughly 60% of the world's total savings, think central bank reserves, national rainy day funds, they're held in dollar-denominated assets.
Mostly U.S. Treasury bonds.
Mostly T-bonds, yeah.
Yeah.
Considered the safest, most liquid asset on Earth. So central banks, sovereign wealth funds, big pension funds globally, they hold dollars as their safety net, which, of course, props up the U.S. financial system. And then there's debt. The dollar is effectively the language of global lending. International loans, especially from big institutions like the IMF, priced in dollars. And maybe most critically commodities. Oil is the famous one, but also gold, steel, copper, even increasingly high-tech goods. The default price is dollars.
So if you need energy, if you need raw materials, you're forced into the dollar market.
Pretty much unavoidable.
Okay, this sounds like a treadmill. If you're not the U.S., you're always chasing dollars. So if I'm, say, a government in Africa and I need to import fertilizer or medicine essentials, and I don't have enough dollars, what happens? What are my options?
Well, you have to get them somehow. You either export more stuff, often to the U.S. market to earn those dollars, or you go to the global foreign exchange markets and borrow them, often paying a premium for the privilege.
Which creates this cycle, right?
Exactly. It creates what some call a kind of structural dollar scarcity outside the U.S. Everyone needs them, but only one entity can actually create them out of thin air.
The U.S. Federal Reserve.
Right. And this constant built-in global demand for something only one country prints. Well, that's the bedrock of American financial power. It subtly affects the price of almost everything, everywhere. Your gas, the cost of building a road in, say, Southeast Asia, it all connects back. To really get why this dependency is so deep, you kind of have to go back to the origin story. Bretton Woods, 1944.
Right, the end of World War II looming.
Exactly. The old financial order was just shattered. Think of the chaos of the 1930s currencies crashing, trade wars.
Yeah.
It was a mess. So you had 44 allied nations meeting up in New Hampshire at this resort, Bretton Woods. The goal was ambitious, create a whole new financial language, something stable, predictable to help rebuild and trade without repeating the past disasters.
And the U.S. wasn't just bringing ideas to the table, right? They had serious leverage.
Oh, immense leverage. Undisputed, really.
Right.
The U.S. mainland was untouched by the war's destruction. Its factories were humming. And critically, the U.S. was sitting on something like 2/3 of all the world's gold reserves at that point.
2/3, okay. So what was the actual deal they struck? What came out of Bretton Woods?
The core agreement was basically this: a fixed exchange rate system, sometimes called the gold exchange standard. All the other major currencies, the British pound, the French franc, you name it, they were pegged, fixed, directly to the U.S. dollar.
Okay.
And the dollar, in turn, was the only currency directly convertible into gold at a fixed rate, $35 an ounce.
So the dollar became the sort of anchor for the whole system.
Exactly, the primary reserve currency. Instead of countries holding bulky, inconvenient gold bars.
Yeah, they could just hold dollars. Because those dollars were supposedly as good as gold, you could, in theory, cash them in.
Precisely. The promise was backed by Fort Knox, by all that gold. And this created the magic ingredient, trust. The dollar wasn't just money. It became a symbol of post-war confidence of American reliability. Governments worldwide started holding dollars, U.S. Treasury bonds, instead of gold itself.
So America's first big move wasn't military, it was financial. Building trust.
Absolutely.
Yeah.
It was rooted in genuine economic strength at the time and this promise of stability. It laid the groundwork for everything that followed.
Okay, so that system, dollars backed by gold, everyone else pegged to the dollar it held for, what, nearly 3 decades?
About 27 years, yeah.
Yeah.
The cracks started showing by the late 1960s.
Why? What was happening?
Well, the U.S. was spending massively. The Vietnam War, Johnson's Great Society programs, they were running huge deficits. And they were printing more dollars than they actually had gold to back them up. This led to something called the Triffin Dilemma.
The Triffin Dilemma.
Yeah.
Right. Explain that again.
It's a paradox, basically. For your currency to be the world's reserve, you have to supply enough of it to meet global demand. That usually means running trade deficits, sending more money out than you take in.
Okay.
But running those big deficits eventually makes other countries nervous. They start wondering, hey, can the U.S. really convert all these dollars we're holding back into gold if we ask? Confidence starts to wobble.
And countries started asking, didn't they? Started demanding gold for their dollars.
They did, France in particular. So in August 1971, President Nixon made this absolutely earth-shattering announcement. The Nixon shock.
They just cut the cord,
Yeah.
ended the dollar's link to gold unilaterally.
Just like that. Overnight, the dollar became what's called a pure fiat currency, backed only by the promise, the full faith and credit of the U.S. government. No more gold.
Wow. People must have predicted absolute chaos, right? The anchor was gone.
Oh, absolutely. Widespread predictions of financial collapse, total breakdown of trust. The immediate question was, why on earth would the world keep using the dollar now? It wasn't backed by anything physical.
And this is where it gets really interesting, isn't it? This is the pivot. They replaced the gold anchor with something else.
Something maybe even more essential, globally speaking. Energy. Specifically oil.
The petrodollar deal, how did that actually work? It sounds kind of shadowy.
It was certainly opaque at the time, not widely publicized. But essentially, the U.S. struck a deal, primarily with Saudi Arabia, the linchpin of OPEC. The reported deal had 2 main parts. One, the U.S. guarantees military security for Saudi oil fields. Protection.
Okay. And in return?
2 things for the Saudis. First, they agree to price all their oil exports only in U.S. dollars, no other currency accepted. And second, and this is the crucial bit, they agree to take the massive piles of dollars they earn from selling oil.
The petrodollars.
Exactly, the petrodollars.
Yeah.
And invest most of them back into U.S. dollar assets, primarily buying U.S. Treasury bonds.
Ah, the recycling mechanism. So let's trace it. Germany needs oil. They have to buy dollars first. They send dollars to Saudi Arabia. Saudi Arabia then takes those dollars
And send them right back to the U.S. Treasury by buying bonds, effectively lending the money back to the U.S. government.
Wow. That's a closed loop.
It's the genius, or perhaps the strategic brilliance, of the petrodollar system. It did 2 things simultaneously. One, it guaranteed constant, massive global demand for dollars because who doesn't need oil? Every industrial nation needs it. And 2, it created automatic buyers for U.S. government debt. These oil-rich nations became major financiers of U.S. deficits.
So the dollar's backing effectively shifted from gold, a finite thing,
To oil, a global dependency,
Right.
an addiction almost. This cemented dollar demand pretty much indefinitely, whether the U.S. was running a trade surplus or, as was usually the case, enormous deficits. It gave the U.S. this incredible ability to finance itself cheaply.
Okay, so we have this system built first on post-war trust, backed by gold, then cleverly pivoted to being backed by the global need for oil. This setup gives the U.S. this unique power, right? Our sources talk about the ability to print influence, to run deficits that would just crush any other country.
That privilege really is the core of its global financial power. Because the dollar is the reserve currency, the U.S. can issue debt treasury bonds, and the rest of the world essentially has to buy them.
Why has?
Because central banks need safe, liquid assets for their reserves, as we discussed. And U.S. T-bonds are seen as the gold standard, a safest place to park huge sums. So there's this built-in demand. This demand lets the U.S. borrow money, fund its government, fund its foreign policy at much lower interest rates than pretty much anyone else. It's a huge advantage.
And that's where this idea of an invisible tax comes in. The rest of the world is sort of footing the bill.
You could definitely frame it that way. Think about it. Every other country has to earn dollars, usually by selling real things, goods, services, often to the U.S. market.
Right.
Or they have to borrow dollars.
Right.
But the U.S., it can just create dollars. Through the Federal Reserve, this fundamental asymmetry acts like a subtle, ongoing tax. Other countries end up holding vast amounts of relatively low-yielding U.S. debt, effectively helping to subsidize the U.S. economy, when maybe they'd rather invest that capital at home.
Which brings us straight to the power of the Fed, the U.S. Federal Reserve. It's not just America's central bank. It's kind of like the world's central bank, isn't it?
De facto, yes. Absolutely. And this leads to the interest rate ripple effect. It's incredibly powerful.
Explain that ripple. What happens when the Fed fiddles with U.S. interest rates?
Okay, so if the Fed raises interest rates, maybe to fight inflation in the U.S., that makes borrowing dollars more expensive everywhere, globally. Critically, it also tends to strengthen the dollar against other currencies. And that is where it gets really painful, especially for emerging markets.
Why them specifically? What's the mechanism?
It's something called currency mismatch risk. Let's take, say, Indonesia. They might earn export revenues in their local currency, the rupiah. But the big loans they took out, maybe from the World Bank or private lenders to build infrastructure, those loans are very often denominated in U.S. dollars.
Ah, I see where this is going.
Right. The Fed raises rates, the dollar gets stronger. Suddenly, Indonesia needs way more rupiah to make the same dollar loan payment. Their debt burden just explodes overnight through no fault of their own.
Ouch.
Yeah. Our sources say emerging markets tremble when the Fed raises rates, and it's not an exaggeration. It can trigger capital flight money rushing out of the country back to the perceived safety of the U.S. forced government into harsh austerity and even push countries towards default. The Fed's decision, made for domestic U.S. reasons, sends shockwaves globally. It has very little to do with the economic health of Indonesia or Brazil or Turkey.
And the flip side, when the Fed lowers rates or pumps money in,
Then the world tends to breathe easier, as one source put it. Borrowing costs fall, the dollar might weaken a bit, easing that debt burden, global capital gets cheaper. So yeah, the Fed holds an immense global sway.
okay, we've covered the history, the mechanics, Bretton Woods, petrodollars, the Fed's power, the hard stuff. But let's shift focus a bit. Beyond the balance sheets, beyond the military might, what's the real secret sauce? Why does the dollar still reign? Our sources seem to point towards something less tangible.
Psychology, trust, belief. It's that invisible layer that you can't really quantify on a spreadsheet, but it might be the most important factor of all.
But trust in what exactly?
It's a bundle of things. Decades of cultivating a reputation, rightly or wrongly, for relative stability. For deep liquid markets where you can buy or sell huge amounts without moving the price too much. Transparency, relatively speaking, and crucially, critically, the rule of law. Faith in American institutions.
Why is rule of law so vital for this global financial role?
Think about it from the perspective of a massive pension fund or a sovereign wealth fund managing billions, trillions maybe. They need absolute certainty. Certainty that contracts will be honored, that property rights are secure, that their assets won't just be frozen or seized arbitrarily by the government.
Even if the dispute involves the U.S. government itself.
Especially then. The confidence rests on the belief in the independence or perceived independence of the Federal Reserve and the long history of the U.S. court system, particularly New York's commercial courts, enforcing contracts relatively impartially. When global investors look at alternatives, say the Chinese yuan, this is often a sticking point. They might see economic growth, yes, but also fear sudden capital controls or opaque legal rulings. That lack of predictability is a major hurdle.
Which explains that really weird thing we see during U.S. crises, doesn't it? Like when Congress is fighting over the debt ceiling or there's major political drama, logic says money should flee the dollar, right?
You'd think so. But what often happens?
Investors rush into the dollar. They buy U.S. Treasury bonds as a safe haven. It makes no sense.
It's the ultimate paradox, isn't it? The dollar becomes the flight to safety asset, even when the source of the global risk is the U.S. itself. Why? Because in a storm, it's still seen as the biggest, most liquid, most reliable lifeboat available. There's simply no other market deep enough or trusted enough to absorb that kind of global capital flight instantly.
So it's this collective belief.
Exactly. Trust is the invisible foundation, as our research puts it. As long as the vast majority of global players believe the dollar is the least bad option, especially in a crisis,
its power persists. The belief itself reinforces the reality.
Okay, but history suggests no empire lasts forever, right? And our sources are definitely picking up on signs, maybe cracks is the right word. In the dollar's dominance, there's this growing talk of de-dollarization.
Yeah, that term is definitely buzzing. It refers to this concerted effort by various countries to reduce their reliance on the dollar. And it seems driven by a couple of main things. First, wanting to escape that interest rate ripple we talked about, wanting more monetary policy independence. And second, maybe more acutely, the fear of U.S. sanctions.
Because the U.S. uses the dollar system to enforce sanctions, right? Cut countries off financially.
Precisely. Access to the dollar system is access to the global economy. If the U.S. decides to cut you off, you're in serious trouble. So finding ways around that is a big motivator for some countries.
So who are the main players trying to chip away at this?
Well, geopolitically, China is the most obvious challenger. They're actively promoting the yuan, their currency, for international trade, especially with countries involved in their Belt and Road Initiative, trying to build a parallel system. We also see countries like Russia, India, Brazil, experimenting more with using their own local currencies for bilateral trade deals, especially for big things like energy or commodities, trying to bypass the dollar middleman entirely.
Okay, so that's the geopolitical push. What about technology? That seems like it could be a real disruptor. Things like crypto or these CBDCs.
Right. Technology presents a different kind of challenge, maybe hitting the underlying infrastructure. Decentralized stuff like Bitcoin offers a non-state alternative, though its role is still debated. But the more immediate potential disruptor might be central bank digital currencies, or CBDCs.
Government-issued digital money, how could that bypass the dollar system? What's the mechanism?
Okay, so right now, most big international payments don't actually move physically. They rely on a system called correspondent banking. Your payment instruction goes via the SWIFT messaging network, which is based in Belgium but heavily influenced by the U.S., telling big banks, often American ones, to basically adjust balances between themselves, move money from Bank A's account to Bank B's account.
And that takes time and gives the U.S. oversight.
Exactly. It can take days, it's complex, and it routes things through choke points the U.S. can monitor or control. CBDCs, at least in theory, promise something different. Direct, peer-to-peer, cross-border settlement, almost instant, like sending digital cash directly from the central bank of country A to the central bank of country B.
Without needing those intermediary banks or the SWIFT message.
Potentially, yes. If major economies could create interoperable CBDCs, they could build a new set of payment rails entirely outside the current dollar-centric system. That's the potential threat.
Okay, so the desire is there from some countries. The tech is emerging. Why isn't it happening faster? Why is ditching the dollar so incredibly hard?
Because the dollar's roots aren't just deep, they're everywhere. They're tangled throughout the entire global financial ecosystem. We're not just talking about changing the currency used for today's oil deal. Think bigger. Think about every long-term international contract, shipping leases, complex financial derivatives, insurance agreements. They're overwhelmingly written in dollars, often governed by U.S. or U.K. law.
Rewriting all of that.
It's monumental. It means rewriting decades of legal agreements, reprogramming banking software, retraining staff across thousands of institutions globally. And then there's the liquidity issue. No other currency market, not the euro, not the yuan, not yet anyway, comes close to the dollar's depth. You can trade billions of dollars instantly, 2047, without causing huge price swings.
You can't do that with yuan or euros on the same scale.
Not even close. The infrastructure, the sheer volume of buyers and sellers just isn't there yet. So the pure inertia, the logistical nightmare of switching is arguably the biggest barrier. It's just easier, safer, cheaper for most players to stick with the dollar network for now. So putting all that together, the deep infrastructure, the trust factor, the lack of a clear alternative, the consensus really is. Well, don't expect a sudden dollar collapse anytime soon. As our sources tend to say, empires fade slowly. The friction involved in replacing the dollar entirely is just too immense for some kind of overnight shock unless, there was a complete and utter breakdown of U.S. institutions.
Right, so if not a sudden collapse, what's the more likely path forward? Dilution, maybe?
That seems to be the most probable scenario, a gradual shift towards a more multipolar currency world.
Meaning the dollar shares the stage rather than dominating it completely.
Exactly. The dollar likely loses some market share, particularly in regional trade blocs, maybe more Russia-China trade in local currencies, perhaps more euro usage within Europe. But it probably retains its central role as the main reserve currency, the key currency for global investment, and the pricing unit for major commodities for quite some time.
And who are the likely co-stars in this multipolar world? The euro, the yuan?
Those are the main contenders. The euro, certainly. If the Eurozone can sort out its integration issues and really deepen its own capital markets to offer a genuine alternative for large-scale investment, the yuan will likely grow in influence, especially regionally in Asia, powered by China's sheer economic weight, but faces those trust and transparency hurdles we discussed. And maybe down the line you could see baskets of currencies or even certain digital assets playing niche roles. But a direct challenger to the dollar's overall dominance still looks distant.
So even in this potential future, the dollar remains the benchmark, the reference point.
For the foreseeable future, yes. It feels like every major financial discussion, every crisis response will still have to start with that question. Okay, what's the dollar doing today?
So what does all this actually mean for, for us, for the listener?
Well, it means U.S. economic policy is global economic policy, like it or not. When the Fed makes a decision about interest rates in Washington.
It affects the price of loans in Nairobi or Jakarta?
Precisely. When the U.S. Congress argues about spending, it sends ripples through global markets. It means global financial stability is deeply, intrinsically linked to the stability and predictability of U.S. institutions. Whether we consciously think about it daily or not, we're all participants in this dollar-centric system. #ShagOutro. Ultimately, the U.S. dollar does more than just measure value in many ways. It defines the terms of value on a global scale. It sets the rules for trade, influences geopolitics, directs capital flows, often invisibly shaping decisions far removed from American shores. It's a system designed, really, way back in 1944.
And that power touches pretty much everyone, doesn't it? Whether you're a farmer in Kenya whose fertilizer costs are tied to dollar-priced commodities, or a tech firm in Germany importing components priced and insured in dollars, you're connected to it. That's what financial supremacy looks like in practice. Which leads us to our final thought for you to chew on. We talked a lot about trust, that invisible foundation. So here's the question. What kind of event, or maybe series of events, could genuinely shatter that global belief? What could damage faith in U.S. stability and institutions so badly that the world finally stops seeing the dollar as the safest harbor? And maybe even more fundamentally, what would it actually take for another currency, or maybe something else entirely, to replicate the dollar's unique blend of liquidity, perceived safety, and just sheer global habit? What could replace that deep-seated belief? Something to think about. That's all for this deep dive. We'll see you next time.